Good morning. These are the things that matter most in Europe's market today. Europe starts the session with a cleaner risk tone after oil dropped and diplomacy hopes eased the Middle East premium, while Asia followed Wall Street higher. But the central question is not simply whether the market opens green. The real question for private investors is this: is Europe's oil relief rally broad proof, or just a short-term rotation that still needs earnings, credit, and AI confirmation? Start with the market setup. Reuters-linked source results show European shares started August higher on U.S.-Iran diplomacy hopes, while Google News results showed oil prices falling and Europe rallying as energy fear eased. That is supportive for airlines, industrial margins, and consumer sentiment. But it also creates a trap. Cheaper oil can lift the index before the underlying earnings evidence has caught up. The useful question is whether lower input costs turn into better guidance, or whether the move is only a macro relief bounce. The cleaner side is companies where falling energy costs can protect margins and cash flow. Pressure sits with energy producers if crude weakness becomes a revenue headwind, and with cyclicals if the demand story is still soft. For private investors, the takeaway is simple: oil relief is helpful, but it is not the same as earnings proof. Second, the AI read-through is still active for Europe. CNBC headlines showed Palantir jumping after a strong quarter and Grab saying AI helped it ship products faster, while another CNBC analysis warned that large technology stakes in AI companies can distort the earnings picture. For Europe, that means the AI story is both opportunity and quality test. ASML, SAP, and Infineon can benefit if spending, software demand, and semiconductor breadth stay real. But a US AI rally does not automatically make every European technology exposure stronger. Potential winners are companies with direct order proof, recurring software demand, and visible margin conversion. Pressure sits with crowded names where the valuation already assumes flawless AI transmission. The private investor filter is to separate AI infrastructure proof from AI label exposure. Theme excitement is not enough. The question is whether the company can show it in orders, revenue quality, and margins. Third, banks and credit are the Europe-specific stress test. Google News results pointed to Eurozone banks tightening lending as geopolitical risks persist, while recent Reuters-linked results had already shown bank earnings strength in parts of Europe. That split matters. Banks can benefit from retail franchises, capital discipline, and deposit income, while tighter lending can pressure property, leverage borrowers, and rate-sensitive consumers. The same rate environment can create winners and fragility at the same time. The cleaner side is banks with resilient credit quality and strong domestic franchises. Pressure sits with property-linked lenders, highly leveraged companies and sectors that need easier financing to defend valuations. In plain English, bank strength is useful, but credit tightening tells you the economy is not risk-free. The underappreciated story is the oil relief rotation trap. When oil falls, Europe can look instantly safer because inflation pressure, transport costs, and consumer squeeze all improve on the surface. But lower oil also reshuffles winners and pressure very quickly. Airlines and chemicals may get margin relief, energy producers may lose pricing support, and exporters still need global demand. The story is not just oil down equals Europe up. The story is whether the market can identify who actually receives the margin benefit. The cleaner side is direct cost relief with pricing power. Pressure sits where lower oil signals weaker demand, not just lower inflation. For private investors, the filter is to watch guidance language, not only commodity charts. If companies do not turn relief into better outlooks, the rally can fade into another headline trade. Here is the stock-led watch list. ASML, SAP, and Infineon. Does Europe confirm the AI supply chain story, or does valuation discipline return? Shell, Total Energies, and Lufthansa. Does oil relief improve the right margins, or does crude weakness simply rotate pressure? Société Générale, BNP Paribas, and Mercedes-Benz. Do banks and exporters show earnings resilience, or do tighter credit and China-sensitive demand become the limiting factor? Market bias. Constructive but selective. Europe can reward relief from energy stress and global AI momentum, but the market still needs company-level confirmation. The mistake to avoid is treating a lower oil price or a green open as proof that the whole region is healthy. The better filter is confirmation. Which companies can convert the macro setup into earnings quality, and which ones only move with the headline. Tomorrow's watch: oil, AI proof, and credit conditions. Watch whether lower crude supports margin guidance, whether AI-linked European names confirm real demand, and whether banks discuss credit quality with confidence. Research context only. This briefing is not investment advice.